So, good morning, everyone. My name's Rupert Thorne. I'm the Deputy Secretary General at the Financial Stability Board. So, as a deputy, it's very fitting that I have three deputy governors of central banks here on the panel with me. On the surface, that may look quite homogenous, but they've all come to their current jobs from quite different backgrounds. On my immediate left, Sir John Cunliffe is Deputy Governor at the Bank of England for financial stability. His responsibilities include supervision and oversight of financial market infrastructures, resolution, and international issues. I should declare an interest here because he's also a member of the Financial Stability Board Plenary and Steering Committee, as well as on the European Systemic Risk Board. So he's very well placed to speak from both a UK and an international perspective. Before joining the Bank of England, John's background is in working for the UK government in the Treasury, Cabinet Office, UK Permanent Representative at the European Union, amongst other positions. To his left, Cecilia Skingsley is Deputy Governor at the Swedish Riksbank. She's deeply involved in retail banking issues in a domestic and international context, chairing Sweden's Retail Payments Council, and also representing the Riksbank on the Committee on the Global Financial System and the Euro Retail Payments Board. She co-chairs the World Economic Forum's Council on the future of financial and monetary systems. And before joining the Riksbank, Cecilia worked in the private sector, most recently as Chief Economist at Swedbank. And then to her left is Timothy Lane, Deputy Governor at the Bank of Canada. He oversees the bank's funds management and currency functions. Particularly relevant to us today is that this covers developments in financial technology, crypto assets and digital currencies. Until July, he held a different portfolio as Deputy Governor, being responsible for the analysis of international economic developments. And before that, oversaw the bank's work on financial markets and Canadian economic developments. So like our other panellists, he has a very well-rounded expertise. His previous background is at the International Monetary Fund, where he served for 20 years. So those are our panellists today. I'm going to ask them a round of questions, and then perhaps a second round, and still aim to leave time to have questions from the audience. So let's begin, and I'll start with you, Sir John. How would you say, let's start with a broad overview perhaps. How would you say Fintech has changed and could change the structure of the financial system? What are the biggest issues for policymakers and for competition and access to financial services?
Thank you, Rupert. That's better. Thanks for the invitation to come along today. I'm not sure what the collective noun is for central bank deputies. For governors, I know it's the wisdom of central bank governors. I think we're probably a practicality of deputies. So maybe if I go into some of the practical aspects as well, it's a very large question. I just wanted to start with a little lesson from the past, because the future is never quite what you expect it to be, and it never quite arrives when you expect it to arrive. So a little example from the internet age. About 20 years ago, we had the dot-com internet bubble in full swing. And the prospect then of a revolution in the way that businesses sold things to other businesses and businesses sold things to consumers had created a huge amount of sort of excitement and hysteria. I think IPOs for dot-com firms went from about 1 billion in 1997 to nearly 25 billion 2 years later. And it was a bubble, of course. The NASDAQ went up 5 times in a few years. And when it collapsed, wiped about 5 trillion of share values. But before you draw the lesson, well, it just goes to show that fintech and the possibilities for the future are hype. The things that the investors saw 20 years ago did happen. They're happening now. We see that at the moment in the UK, internet sales to consumers are about 1/5 of all retail sales, and it's growing. About half of UK consumers say they prefer to shop online, and global e-commerce is worth over $2 trillion now. So the first lesson is things do happen, but they sometimes take a lot longer to happen than you think they will. The speed is quite difficult to read. And the second is it didn't quite happen in the way we thought 20 years ago it would. We thought then that there would be an ecosystem of small companies interacting directly with consumers and with bigger companies, and some of that has happened. But what also happened in a way that we didn't envisage was the growth of the electronic marketplaces, the platforms, the Amazons, that actually bring together the smaller players and provide an interface between them, between the consumer. Amazon, which was one of the dot-coms in the mid-90s when Jeff Bezos founded it, is now, I think, responsible for 50% of online shopping in the US, and the number is relatively similar in the UK. And putting that together with what's happened in data and data analytics, the cloud, social media, and the way we interact, has just created what people call the big techs, who actually dominate very much our connections between each other through the internet. So the future is a variant, has turned out to be a variant of what we thought. It took a bit longer. It's proving very powerful, but it's happened in a rather different way. And what it's shown is there is a huge appetite in society, certainly in the UK, for a much more interlinked, networked, peer-to-peer society, transacting digitally and interacting socially through digital platforms. And it's also shown that some of the promises that people had 20 years ago of a much more efficient way of transaction between individuals, much more choice, much better matching between sellers and buyers, much greater scope, and a more seamless interaction of those transactions into our social lives or whatever. Those things have happened. It's, for me, pretty inconceivable that finance and the provision of financial services will escape or somehow avoid this change to a more networked society interacting in that way. But so far, actually the changes that we've seen in the UK have been relatively limited in the financial space compared to what's happening in the online retail space for consumers. So the question, I think, that we think of a lot on the Financial Policy Committee, the Bank of England tries to look at financial stability risk is to some extent how will this happen and how fast will it happen. And at present we have the fintech companies in the UK are still relatively small, and they're engaged in finding small niches where there are frictions in the system or where they can skim off a little bit of the value that's in one section of the financial production chain. We're seeing them trying to come into payments in that way. We're also seeing some peer-to-peer lending platforms develop, which are growing, but they're still a relatively small part of the overall credit intermediation that you see in the UK. And at the same time, we've seen the incumbents, the big banks, move towards partnering with fintechs and move also towards exploiting the new technology. I think all of the major UK banks use the cloud to make themselves more efficient, to lower their costs. Online banking in the UK has switched from people using their laptops and their home computers to using their smartphones. I think 22 million Brits now prefer to interact with their bank through a smartphone app. And the banks are trying to exploit big data, data analytics and AI to try and deal with this revolution. I'll say a little bit more about that in a moment. But actually, that suggests a story of an evolution where technology partners with the incumbents to offer these benefits. But there is actually a possibility that the transformation happens much faster using what I call the big tech firms and the big tech platforms. At the moment, they're not that active in the UK in financial services. But an example of their size is Facebook, which which is the smallest of the so-called big tech companies, its market capitalization is more than the market capitalization of all of the banks and all of the insurance companies listed on the FTSE 100 index. So it gives you an idea of scale. And if I increase that to take Amazon or Google or whatever, the much bigger platforms, it's a much larger event. So these are huge players. Secondly, we've seen what's happened in China, particularly with Tencent and Financial. And Financial, I think, has got 35% of all payments in China, half of all online payments. And crucially, because it moved into the provision of financial services, it has the biggest money market fund in the world at about $230 billion. And that transformation has happened within 2 to 3 years. And the issue that we are looking at now in the UK is, do we think these big tech firms will come into the provision of financial services? And if so, how? And there are really two scenarios. The one, which I think is the more likely, is that they do come into the provision of financial services, but they stay just outside the regulatory boundary. So they act as aggregators, they act as platforms that introduce companies that provide financial services to customers. They may become involved in lending to consumers and lending to businesses, which in the UK is not a regulated activity. They will become involved in parts of the production chain and ultimately try and control the relationship between the individual and the provision of financial services, bringing financial services together, swapping your accounts around, offering products. The second is that they actually cross that boundary into the regulated activities which really are around maturity transformation and deposit taking. In effect, they become banks. There's a suggestion that one of them may be asking for a banking license for part of its activity. I think it's more likely they stay outside because the cost of regulation is very high and they use the financial incumbents more as utilities. But actually what we're starting to realise on the Financial Policy Committee is this boundary is not clear. It's not very clear when you start to disaggregate the activities in the financial sector. It starts to become very unclear about why you regulate particular things and what you regulate them for. And I'll talk about that in a second. We see huge benefits in this. If it can bring to financial services the sorts of efficiencies and benefits it's brought in online retail, opening up a much wider set of products to a much wider set of people and at lower cost, there's huge value. But we see some risks as well. One risk just worth mentioning because it's often forgotten is certainly if it's the big tech companies that come in, the issues we have in managing cross-border risk just become much greater now because we now have huge international players actually involved in retail, whereas at the moment we have them involved much more in wholesale between countries. We would have them involved in retail. Secondly, there is the threat which the governor mentioned to incumbents. The threat that this just damages their business model and so they're unable to be profitable, which means they can't generate capital, which means they'll be less resilient, or that it will drive them further out on the risk spectrum because they take more risk in order to compete. We did a financial stability stress test, long-term stress test of our major banks, asking how they would deal with some of these scenarios, and I have to say their answers were particularly reassuring. The second risk is operational. I think the big tech, fintech companies are probably better at managing digital platforms and digital systems than the big banks, but nonetheless they operate outside of our regulation and under very different data protection rules. But I think for me the most difficult thing is actually it's forcing us to think again about prudential regulation. So there are clearly issues around consumer protection, how you sell things, and market integrity. But there are also issues about what you care about at a prudential and a macro-prudential level. To give an example, most of our prudential regulation in the UK is built on the idea of deposit takers. So actually, if you're a deposit taker, then you're regulated, your leverage is regulated, a maturity transformation, liquidity transformation, these things come under regulation. If we find that much of the provision of financial service is not operating through licensed deposit takers, maybe there is no leverage in the system, maybe this is just platforms introducing providers of funds with users of funds, but then we have to think about the dynamic of the system and how that ecosystem reacts under stress. And would we care, for example, in the UK, if Amazon had a money market fund of 200 billion pounds? What would the regulation of that need to be, and how would it compare to the regulation of banks? So when we had everything bundled together in big banks, provided we caught them as deposit takers, we actually managed to have an overview of everything they did and control or influence over everything they did. In this world, where you decompartmentalize, you disaggregate all the individual pieces, you have to think much harder about why do I care about that piece, and actually I care about how that piece interacts with all the other pieces, and that's a much more difficult thing. The Financial Stability Committee of the Bank of England has a remit to keep looking at the regulatory perimeter and to keep thinking about system risk and how the parts of the system fit together and whether you bring something into regulation or not. So this is an area that we keep under constant review. There's no one simple answer to how you manage these risks. There's only, if I go back to my little .com example, there's only just watching how things develop and try and make sure that you've done the thinking in advance of the development that will enable you to respond. I'll stop there.
Thanks very much. That's a very comprehensive and insightful overview that sets a good start to the panel. Cecilia, I'd like to ask you about one specific part of it, but a very big part of it, the payment system, the retail payment system. Sweden has become a byword in the last few years for low cash usage, many people say moving towards a totally cashless society. And that seems a great success story for Fintech. What have been the experiences there? Are there potential problems in moving towards a so-called cashless society? And what is the view of the Rights Bank on this?
Well, thank you, and good morning, everyone. So we heard that the tech changes, they are opening up new preferences and opportunities and changes the level playing field in many sectors. And there are many sectors in the economy that sort of go through this, both very positive but also very disruptive forces. But now we're coming very much closer to what's in the interest for central banks and regulators, meaning that this concept, a social convention called money, that was pretty stable for the best part of 100, 200 years perhaps, when central banks have been running the show, is also into questioning and being disruptive. So I'm going to start explain a little bit why Sweden is moving towards what we call a cashless, potentially cashless society, and how we think about it. First, just to give you some numbers, the outstanding value of cash in circulation in Sweden is now at about 1% of GDP, which takes us to the lowest among any country that I can think of. Germany has outstanding value of 10%, Japan 20%, etc. Most countries also the outstanding value percentage of GDP is increasing or fairly stable, but in Sweden it has dropped for a number of years. And we think it moves both from the supply side and the demand side. So first looking at the supply side, meaning how the private sector offers various payment methods. So we have few but large banks, and they have been cooperating on infrastructural issues for the best part of 50 years. So clearing, automatic clearing was put together in a joint company many years ago when the ATM systems were developed. You had a joint infrastructure for that, so you didn't have to go to certain ATMs depending on which bank you had. When card technology came, the Swedish banks adopted to the international card schemes rather than develop their own. They share the cash in transit operations, so the Riksbank doesn't have an involvement in the cash and transits and the storage of cash. We have one point of entry and exit for cash in the whole Swedish geography, and the rest is we have left sort of delegated to the private sector to manage. And also, the legislation in Sweden doesn't oblige neither banks nor shops to actually handle cash or offer any cash services. So if you walk into a shop or a restaurant in Sweden that says no cash, cards only, or something else, that's perfectly legal to do so. And when technology sort of flips and preferences changes, these changes can happen quite quickly. Another thing which is of interest for people who are thinking about lowering the cash usage in the society, I think one of the reasons for why the cash usage dropped considerably in Sweden was when retailers, about 15 years ago, had to adopt to a particular cash registers, which has a sort of connection to, it's not an instant connection, but it's sort of connection to the tax authorities. So if you are a customer coming into a shop and you buy something, haircut or shampoo or whatever, and you want to have a receipt, then the retailer has to register that in the cash machine, and that can't be then being manipulated. So the upside for a retailer to take cash sort of dropped as all transactions became visible. So those are the supply factors, I think, that is pushing this development. On the demand side, what we as human beings up in there in the Swedish thought are doing, I think it's important that there is generally a high level of trust among all the Scandinavians in terms of trusting infrastructure, trusting companies, trusting the public sector regulations. Some might call it naivety. I would like to call it history. We have had a stable social and political development for a long time, so people are getting used to that and perhaps exploit it to a certain extent. There is also a high level of adopting to new technologies. I think we are among the top 3 in the world according to World Economic Forum, jumping on new technologies. We were quick with computers, smartphones, etc. And it's very easy to live cashless now in greater parts of Sweden. If you have a card, a debit card mostly, and you have the instant payment app called Swish, you can very happily live your life without ever using cash. As a matter of fact, actually 4 out of 10, according to our service, 4 out of 10 has not used any cash when we ask how did you make your payments this last month. But the views are also conflicted. 4 out of 10 decides not to use any cash at all, but 7 out of 10 says, well, cash is something nice to have in society, but not certainly especially for me as a person. It's something that it's a sort of good that is expected to stay. So the changes have started. Banks are withdrawing cash services. Shops are stopping to offer cash payments. And it's easy to think that this is mainly older people in rural areas, people more on the conservative notions that are having conservative views that are protesting against this. But this is fairly broad-based. There are a lot of people who doesn't want to be dependent on banking services, and there are also some who actually can't use payment methods, at least the ones that have been provided so far. But if we would just look at current trends and look at how people adopting to these trends, we have to be at the central bank sort of prudent and prepared for a situation where the society is more or less cashless, cash-free in a few years from now. And when I say cash-free, I don't mean that the Riksbank will stop providing cash. It's in our legislation to provide the society with cash. But when there's a situation occur where cash is no longer a useful tool to have in most people's economy, then I think the sentiment will flip quite quickly and more sort of the external effects, the network's effects that works in favor of a payment method starts to work the other way around. And we can still make person-to-person transactions in cash, but it won't be very attractive. Now, on the political side, the legislators have been a bit not very interested in getting involved in this development, but now recently they have turned around and said, right, we want to put in a kind of minimum legislation, so not more than about 0.3% of the Swedes should have more than something like 25 kilometers to the nearest cash withdrawal point. So the idea is to put some kind of grid across the geography, so have to provide a minimum access to cash. And that would guarantee availability, but it would not guarantee usability, because the politicians have not so far been interested in reinforcing retailers to accept cash. So we have to expect this to continue. And then the question is, how much of a problem could this possibly be? Well, it's certainly an unknown territory we're going into. No one else has experienced this before. Going cashless would mean that people would lose an alternative, and usually we think as an economist that one less alternative means that we are worse off. And it opens up also a very interesting fundamental question, which is, will actually people still trust a monetary system that no longer makes it possible to convert between inside money, meaning commercial bank money, and central bank money, which they have been able to do for a very long time. Going cashless also has some efficiency and safety issues to come with it. If you think about the payment market, at least the way we think about it, it resembles a natural monopoly. There are high investment costs, there are high economies of scale, and there are also high network effects, which means that the usual forces of competition and inclusiveness is not really there in the payment system. And this creates quite a challenge in terms of supervision and regulations. The public sector objectives of having a safe and efficient payment system perhaps is not exactly in line with what different private companies within the payment system is trying to provide. And just to give you one interesting example we've been looking into, since 97 or 98% of all the transactions and consumer transactions in Sweden is done by cards, we asked ourselves at the central bank, okay, they're all online, more or less online payments. What happens if the system goes offline? One card provider gets into a digital technological problem, someone cuts off an important telecommunication cable, that sort of things. And we realized that people have very, very different possibilities to make what's called offline payments if there is such a disruption. And if it lasts for a long time, 3 days, 6 days, 10 days, we realize that there is a lot of vulnerable households out there. So we have to think a lot about resilience, redundancy, and that can be a bit tricky if it goes completely private. So we were working along a couple of different work streams, thinking about how do we supervise and potentially regulate what could become a privately managed payment system in Sweden. But we are also, this is what creating the most attention from abroad and also within Sweden. We're also looking into whether it's feasible and appropriate to somewhere along the line issue what we call a central bank digital currency, or the name of it as we call it, an e-krona. To first working as a complement to cash, but in the long term substitute cash. This opens up also a number of fundamental issues, such as what is an appropriate division of responsibilities between the public and the private sector, and in what forms should actually money be provided. Are we sort of satisfied with the private sector do it on their own, or do we need to continue from the central bank side to offer members of the society our own version of money? So we're running a project. We've launched a couple of staff reports. No decisions have been made so far, but this is very much an interesting issue, both from a research perspective and from a policy decision perspective. So far, and I can go into this if you have specific questions, the staff assessment is, as long as you keep the concept fairly narrow, take away the ideas of big account-based structure, unlimited deposit possibilities into the central bank for an individual, but think more about it as a value-based e-krona, a card-based system or an app-based system with limited amounts of much you can put in. We think there are limited consequences in terms of how you conduct monetary policy, limited consequences also on the macroeconomy in general, but also on financial stability issues. But this is tricky issues, and that's why we started early, in order to create room to maneuver in the future in case we need to do so. And I'll stop there for the moment.
Thanks very much, Cecilia. So you certainly illustrated there's a very rich and complex set of factors, legislative, regulatory, infrastructure, social, that are going into the development of payment systems and potential for cashless society. I'm sure we'll come back to that in questions, and also relatedly in the second round. Now, Sir John, in his questions, raised some very provocative questions about the boundary between traditional financial regulation and the sorts of activities that large and small financial firms are in. Tim, I'd like to ask you about some of those aspects. What are some of the risks that you see from financial institutions' reliance on third parties? For instance, cloud services, data provision, and are there potential gaps in regulation or oversight, and what can be done to address those?
Okay, thank you, and I guess I'd like to start by thanking the Toronto Centre and the Central Bank of Turkey for organizing this event. I think really it looks like a really interesting day of discussions on these topics, and also to thank you very much for your hospitality. Now, this is a topic, this whole question of third-party risk is one that was raised by the Fintech Issues Group of the Financial Stability Board. And I mean, basically, I guess a couple of points to start with. One, of course, there's nothing new about third-party risks. Financial institutions have been outsourcing various services for years, and that's not unique to financial institutions either. I mean, any company relies on third-party suppliers and providers of services, and there are always risks to be managed there, which involve doing due diligence, making sure that the risks that the third party faces are being handled adequately, so that they don't resonate on the company that's relying on those third parties. I think a second thing is that for the as we're observing the development of fintech and more generally the role of technology in the financial system, and we are seeing, as I think John already noted, an increasing reliance on cloud-based data storage, and also cloud-based analytical services, and that for the companies that are doing that outsourcing, it generally is both cost-saving and I think in most cases actually risk-reducing, because I mean generally a company like Amazon Cloud Services is going to be way better equipped to deal with various cyber risks and other operational risks than a small fintech startup located somewhere in California. And so it's so that it's really not about the risks to the individual company. I think the risk that is really relevant is the fact that this increasing reliance on cloud provision creates a form of interconnectedness in the financial system that we haven't seen previously. It's really the fact that you have relatively small number of cloud service providers that are providing those services not just to a large slice of any individual country, but even to the global financial system. And so the concern is that even if the risk of any operational failure is very small, it could become potentially very, very significant and even catastrophic, to the extent that it affects not just an individual financial institution, but a whole swath of the financial system. And that's, I think, particularly relevant to the extent that we're looking at companies that are are too small to even be within the regulatory perimeter. Some of the fintech companies that are really not viewed as being systemic individually. But if they're facing operational risks which are correlated with the risks faced by a whole swath of the world financial system, then those risks collectively start to become material. Now, of course, the regulatory framework already addresses third-party risk for the institutions that are regulated. So a bank has to be, is responsible for doing due diligence about its, with regard to its third parties. But the questions that are being asked in that case are your data safe enough? I mean, are they as safe when you outsource them as they would be if you managed it in-house? The question they're not actually having to ask is, well, if something happens to your data, is the same thing going to happen to the data of, a third of the global financial system, which could then become a systemic issue? So this sort of systemic dimension is one that really hasn't been focused on. Now, then the question, well, how can we quantify this? Well, I think the starting point is we don't really know how serious an issue this is. Well, because we don't really have systematic data on what data are being outsourced, and for some institutions we know that it's only their HR data and things like that, which are not ones that could pose obvious concerns with regard to systemic risk. But on the other hand, increasingly other data, transactional and balance sheet data and account data may be being stored, but we don't really have systematic information on how pervasive that is and how rapidly it's growing. The other thing, of course, we don't know is what goes inside the cloud. Because within the cloud, of course, there are firewalls and safeguards and so on, and really the financial regulators don't have any visibility into how the extent to which these risks are interconnected. Now, of course, some people would be inclined to say, well, we don't really know what risk it is, so why should we worry about it? Now, I think as regulators and therefore professional worriers we would draw the opposite conclusion, which is a risk that you don't understand is even worse and more serious than a risk that you can actually quantify and understand more fully. So, in terms of what one might do about it, I think, obviously, as I said, you need more information, but the sorts of solutions I think I think that we probably would not want would be, defining the cloud providers as systemically important financial institutions and requiring that they're subject to all the same regulatory restrictions that large banks are subject to. But there may be some need to at least to have some regulatory scrutiny of how the data are being managed by companies that are responsible for the data provision for a large part of the world financial system. And at least we need to think about how to address these risks and to make sure that they're being adequately managed.
Thanks very much. I'd like to come back with some additional questions to the panel, and then I'm going to open it to the floor. I'm sure you're going to have lots of questions. So if I can ask the panel, try to keep your second answer to no more than 5 minutes, so we need time for questions. Let me start with Sir John. You raised a number of provocative questions. You didn't answer necessarily all of them yourself the first time. Can I ask you, what can authorities do to help create the conditions for safe innovation and the development of technology that allows for both the reaping of the benefits and controlling risks?
The first thing I'd say is maybe very obvious, but worth saying: keep an open mind. So there is a tendency of authorities to cling to what you know and to what you think is safe. And so we find the Bank of England brings together supervision of firms, macro-prudential payment systems, and there is a tendency from the supervisory and regulatory side to hold on to what you know and resist what you don't. And I think it's a mindset issue, but it needs in regulatory authorities that, which is not to ask questions, but is to say, approach these things with an open mind, try and analyse what you care about and why you care about it. It's a constant challenge. The second point is be very alive to the competition aspects of what you do. In the UK, on the payment system side, we now have an economic regulator outside, it's in the Financial Conduct Authority for payment systems that looks at competition, but nonetheless how we act affects competition. So the Prudential Regulation Authority set up a new bank unit some years ago to make the entry of new banks into the system much easier, to reduce the barriers without reducing the risks. And think about the competition aspects, and it goes both ways. We have a framework for looking at payment system providers with all of these new providers coming in to the market, taking different parts of the payment production chain that says we, at a certain sort of size, we leave them alone. But when they get a bit bigger, and sometimes it's difficult to know how big they've become, we will engage with them and ask them questions formally, and then the next stage will be to think about putting them under regulation. You realise that once you engage with them formally, you give them a competitive advantage, because they instantly go out and say, well, they don't quite say we're authorised by the Bank of England, but they go out to say we are now inside the regulatory perimeter, which of course they're not, and that gives them an advantage over others who are not. So think very carefully from both directions about the competition aspects of how you deal with them. And the third thing is central banks can actually help provide the hard and the soft infrastructure for innovation. We are redoing our real-time gross settlements payment system, which is the high-value payment system that sits at the top of all the payment systems in the UK. Up to now, it's only been open to banks, and to the large banks. We have 22 members of RTGS. In the new system, we open not just to banks, but to non-bank providers. We now have a couple of non-banks who are direct members of the system. And then as payments becomes a more disaggregated industry, we'll have more non-bank players join. We have to ask some hard questions about how will we deal with money laundering and other concerns about these. Reputational risks to the central bank, because you're allowing people who aren't the banks you're familiar with to plug into your payment system. And then what sort of financial resources do they have to have? Do they have to have accounts with us, and are they just accounts for depositing, or should we lend to them? We decided we should not lend to them. But those issues were quite complicated. But the aim is to have a high-value payments rail that anyone can plug into. And then we're thinking also about how we can make those developments work with distributed ledger technology and the rest if that comes in. That's the hard infrastructure that central banks can do. The soft infrastructure is around regulation. Standards, the LEI, the legal entity identifier, hugely important in this. The ISO standards, the new ISO standards for payments, 2025, I think it's 22. Again, hugely important that we bring that in, etc. But also our regulation of cryptocurrencies, the way in which we regulate initial coin offerings, all those things we can do in the regulatory system. So hard infrastructure and soft infrastructure, I think, are very important.
Thanks very much. Now, I'd like to make a confession at this point, and that is that I'm an absolutely appalling visionary about financial developments. And I remember, and technology, I stretch back to being a student in 1982 when somebody first told me that barcodes were going to be introduced for use on all products. I said, that's completely impossible. You'll never get everyone to stick a barcode on the wrapper of their products. Excellent. And I think about the 1990s when I was working in the Bank of England. One of my colleagues said, why do all the financial institutions put up with the central bank setting interest rates and restricting money supply? Why don't they set up their own system of network and set interest rates and supply themselves. And I said, it's just a fantasy world, let's get back to real work. So, on that note, I'd like to ask you, Cecilia, as you're more of an expert than me, cryptocurrencies, it's on everybody's so-called cryptocurrencies, I should say. No fintech panel would be complete without it. It's seen by many as or by some at least, as a promising new form of payments that could potentially replace traditional currencies. Do you see that as a likely outcome?
Well, to start with a short answer, no. Leaving these aspects of cryptocurrencies or crypto assets being an investment tool and just focus on it as money, I think they are a very unsatisfactory version of money. This is the classic central bank answer, I know, but I think it's important to reinforce that we think about a good working version of money as a stable store of value. It's a store of value that is stable, that is very important, and it's also an efficient medium of exchange. And cryptocurrencies fails on both these criteria. But I also like to hedge this statement a little bit and say things like, it depends, and could also say so far, because I think it's important to keep in mind here that the industry that are producing these things they will continue to innovate. And the attraction in becoming the Google or the Facebook in creating money and payments on a worldwide basis is endless. The attraction in that is endless. So I think the payment industry as we know it, but also ourselves as central bankers and regulators have to really keep watching this and constantly think about, do we actually provide the social convention money that we are the standard setters we are the standard setters to provide money in a safe and efficient way and in line with what people actually prefer and what works for people. I think potentially we can see different kinds of services or products coming out from the cryptocurrencies innovations. Potentially not what we see right now. But I do think that I know some central banks are looking into central bank digital currency as a way to weigh against cryptocurrencies. I don't think that is necessarily the right way to think about cryptocurrencies. They are in the payment space mainly used for criminal reasons, for illegal purposes. If a central bank come out with a digital currency version, I don't think criminals would jump into that. I don't think it's our job to sort out their payment problems. I think they will try to avoid fiat money system as long as they can. But it's a failure every time an honest person who wants to make a perfectly legal transaction finds any reason to end up using bitcoins or bitcoin's successors instead of going into use the regulated payment system that we are all a part of. So I think there are better low-hanging fruits to use if you want to improve access to financial services. And there are more conventional tools that basically that can be used. And I can echo Sir John's comments about the real-time gross settlement system. We are also thinking and spending a lot of time about how to improve that. That has also traditionally in Sweden been closed for banks and infrastructure companies, but now we are thinking about, do we need to open it up, and what should be the scopes of that, and how do we facilitate that? The second thing, which is also comes back to this issue of lowering the cash usage in society, if you not only already have supported the provision of an instant payment settlement system, making it possible for making person-to-person payments on an iPhone, mobile phone, or iPad or something equivalent, it's time to start doing that, because that is definitely a very simple and efficient way to make people adopt to electronic payment quickly. And then we haven't stopped improving. We participate in the instant payment app Swish since 2012 when it was inaugurated So we make it possible to make instant transactions 24/7 through our real-time gross settlement system. But the payments are growing out of that, and we need to think bigger. So we are now considering asking for joining the ECB instant payment system called TIPS, which has just been launched, because the appetite for making instant payments is growing, and we had to follow people's preferences. Otherwise, someone else will come in and do our job for us. And central bankers, we're supposed to be the best ones when it comes to money and payments, providers of payments, independent of where technology takes us. I'll stop there.
Thanks very much. Let's stay with crypto assets for a moment. The FSB published a couple of papers this year and assessed that there are currently no global financial stability risks from crypto assets, but nevertheless, the market needs to be closely monitored in case such risks do develop. And there are currently a host of regulatory issues other than financial stability. Tim, what concerns you in this area, or do you think the concerns are overblown with crypto assets coming well off their peaks at the end of 2017?
Well, I think there are some concerns here. I think in terms of the current crop of crypto assets, even if there aren't major financial stability issues, because these assets just have a relatively small footprint in the world financial system, and it's a footprint that is now about a third of the size that it was a year ago, because of the collapse in the valuations of these things. At the same time, there are already issues about the adequacy of anti-money laundering and controls of other abusive financial transactions, and there are issues of investor protection and market integrity. The other thing about the financial stability side is that even if these assets are not currently large enough to really have the FSB report basically concluded that that these assets don't have a very large footprint, and B, that they're not really interconnected with the rest of the financial system. You don't have banks holding crypto assets in their portfolios or taking crypto assets as collateral, and the other sorts of channels that you would think of as being worrisome from a financial stability point of view. At the same time, it's important to remember that there are dozens of new products being launched every month, and although the current wave of these products are, as Cecilia said, largely speculative or used for criminal transactions, at the same time there could be other products that could emerge that could turn out to be seriously useful, and if they're seriously useful, they could get adopted much more rapidly than anybody expects, and that's and at that point, I think it's probably not a good idea to wait until that happens to start thinking about how we might want to regulate these things in order to ensure that their financial stability implications are being adequately addressed. I think the big concern that we see in the global regulatory structure is the fact that it's very fragmented, and even though you do have very important efforts going on to ensure that their implications are being addressed, and regulators are basically looking at these assets with regard to their function and classifying them and are taking steps to bring them under the regulatory perimeter. At the same time, the classification of these assets are quite different in different jurisdictions, and so you have question of whether if a new product is launched, is it classified as a security? Is it classified as a payments instrument? Is it classified as a commodity, or none of the above? And then you have cryptocurrency exchanges, for example, which in some jurisdictions might be classified financial market infrastructures or platforms. In some jurisdictions, they're classified as banks, and in others as none of the above. And of course, even for those classifications, different jurisdictions are making different decisions as to how to regulate these products. And meanwhile, you've got dozens of these products being designed specifically, being invented every month, many of which are being designed specifically to exploit these gaps and inconsistencies in regulation. And so in this context, it's really important for regulators to do more to bring together the different aspects of regulation and to try to get some consistent definitions and classifications and to harmonize in areas where harmonization is needed. Of course, harmonization isn't needed everywhere. I mean, there may be aspects like consumer protection where different jurisdictions can really adopt different approaches without any serious consequences. But there may be other areas, and certainly the anti-money laundering aspect is one of them, where it's absolutely essential that you've got consistent classifications, because otherwise you're going to have tremendous potential for leakages, which again are going to be exploited.
Thanks very much. So I think there's some consensus there on the risks associated with crypto assets. I'd like to open the floor for questions from the audience. The first panel of the day. People sometimes are a little shy, but a question in the front here. Do we have microphones or? Yes, we do. If questioners could introduce themselves before asking the question.
Thank you. Emre, Central Bank of Turkey. Thanks a lot for this informative session. I have two questions. The first one is for Timothy and Sir John. The second one for Cecilia. And I highlighted some key words from you, Timothy, as you mentioned about systematically important institution. You classify data cloud providers. It was very interesting to hear. Is our data safe and operational risk? Because when I think of operational risk, a recent example maybe is from Huawei. It's 90% of the telecom operators are working with Huawei, right? And maybe we can easily classify this company as systematically important institution. And also UK recently mentioned about security issues with this company and had some warning. And when I think of Sir John's comment around international players, online retail, is it likely that what we hear from governments regarding the security warning for these companies, maybe one day we hear a similar thing in your prudential regulation measurement? Be careful with this international player. They're holding your data and the security gaps. If you can elaborate the interaction between these international players and the security gaps and the financial stability would be great. And for Cecilia, you're probably the closest with 1% cash in the world to digital currency for a central bank. I read a lot about the central banks, and I think it's like everyone wants to go to heaven, but no one wants to die. No one wants to try this digital currency thing, but probably you're the closest one. And if you can elaborate this interaction between central bank digital currency and commercial bank interaction, because how this monetary transmission will gonna work, because we in our financial stability report with our in our recent issue, we discussed about how the commercial banks will gonna evolve into what direction. If central banks take control over this digital currency, will they going to evolve to a kind of asset management company because they lose their credit lending capacity? Thank you very much.
Okay, let's, who wants to go first? There's questions around operational risks in cloud services, third-party providers, and questions there on the interaction of central banks and commercial banks in new digital currencies.
Okay, well, shall I take the first that first question, Lee? Yeah, I mean, certainly what my earlier remarks suggest that there is the potential for the cloud providers to be systemically important with regard to the financial system. And this is a contrast to the traditional nature of operational risk. I mean, typically operational risk is viewed as being idiosyncratic and still potentially important and important for regulators to be on top of, but at the same time not systemically important. So this is a potential implication, but again, it's one we need to understand more fully, and it's one that I think probably the answer is not going to be to try and bring these cloud providers within the perimeter of financial regulation, except in a very limited sense. But I think before we, certainly it is a problem. It's one we need to understand better, and how much of it really requires, having some oversight of the cloud providers, and how much of it is basically something that requires more redundancy in the actual outsourcing behavior by the financial institutions, I think is something that needs to be carefully considered. So again, we sort of identified a problem, but not the solution with regard to how the cloud providers are regulated.
Okay, thanks. John, did you want to add something? Or?
Well, you addressed part of it on the UK, the recent UK decisions.
And the government.
Yeah.
Security issues.
Yeah. So
I was thinking about whether one day we hear similar warnings from Bank of England.
So I'd say maybe a number of things. Start from the very general, particular. Operational risk in the financial sector is going up. It's going up almost exponentially as we turn to more and more complicated systems, and as we get cyber security threats. We have powers in the UK from a financial stability point of view to bring third-party providers under regulation. But we tend to distinguish between third-party providers within the financial system, you think credit rating agencies or benchmarks or indices, and third-party providers like power, if you cut the electricity off, we have an outage, power, telecoms, and the like. And for the second, it would take a lot for a financial stability point of view for us to try and regulate the telecom system. There already is a telecoms regulator that is supposed to be doing that job. And the recent security announcements were really about the provision of telecom services to the UK and the extent to which source codes have to be opened up in the production of software. It would take a lot for us to step into that arena. We would depend on the authorities that deal with that, or the authorities that deal with data protection, to be the first, actually second and third lines of defense for those things. That said, I'll just say one thing about the cloud. Our very strong view is that the cloud providers are better at cyber resilience than the banks. This is what they do. Their whole business model depends on it. So operational and resilience is stronger in the cloud. But the issue for us really is when I said we look for other authorities who are doing certification, regulation. It could be overseas authorities that we trust. And around the cloud, it's not at the moment clear who those authorities are, which I think is why it's an open question. Whereas for telecoms, it's a different issue.
Can I? Yes. So the question of the interaction between central bank money and commercial bank money, well, that's one of the really key, tricky issues when it comes to central bank digital currency. We try to provide a service to society called money across technological changes, but we don't want to crash the credit intermediation while we do that. We have written extensively about this. You can find it on our webpage, but just a couple of comments. First of all, there is already a competition between the central banks and the commercial banks because we're both providing money to society, and then people can switch back and forth as they wish. And it's the capital regulations, liquidity regulations, deposit insurance system, etc., that makes it convertible one-to-one, okay? But we are already there. So if we stop producing cash because there is no more a need for it, that is the big change, actually. It's not the other way around, that we can carry on do it, but within a digital form. That is just carrying on our previous role, but in a new technological form. Well, that said, how will banks react if we provide this? Well, it depends a lot on how you design it, if you put interest rate on it or not, and if you put an interest rate on a CBDC, it becomes like another monetary policy tool, so that opens up a completely new set of discussions. But I believe very much in banks' competitiveness. They can offer so many more services than what the central bank can do. We are providers of the public good money in a standardized form, and the banks do so much more. Some people are worried that the funding structure will collapse or implode in one way. To that, I'd like to say that the funding structure of a banking system is not given by God. This is affected by legislations, by pricing, even banks' own behavior affects also by customers' preferences. There are new players coming in, are interested in the deposit base. So I don't think it's a role of us in the public sector to protect particular business models, but we have to be, as Christine Lagarde said in a speech about these issues in Singapore about 3 weeks away, when we explore CBDCs, we should do it sort of in a serious, careful, and a creative way, which to me says that we should probably do something along this path. I'm not sure exactly to which scope and in which time frame, but if it turns out that we would destroy the credit intermediation, we just can't do it. We have to refrain from doing it until we know more.
Thanks very much. John, you wanted to add something?
Just on this, because spurred by the Riksbank, we're all thinking about this question, being asked this question. I think the view we've come to is it's quite interesting how cryptocurrency has forced people to re-examine the question of what is money, and then you realise it's not as simple as you think it is. But we have a system that's grown up over time that nobody designed, with different levels of technology kind of overlapping each other. And we use some very old forms of money, still coins. We use some very new forms of money. For us, we think that our key responsibility is securing the value of the unit of account. Okay, because it's for the UK that's sterling, and maintaining people's confidence in that value. Because if that breaks down, they will look to alternatives, either other currencies or cryptocurrencies, and maintaining people's confidence in the safety of their money, which is either a claim on the state through banknotes or whatever, but more a claim on the banking system through our regulation of the banking system, as Cecilia mentioned, prudential regulation, deposit insurance that says it's private money, but you can use it because we've taken essential protections. And then we have to make sure that we have too big to fail resolution apparatus that means we can't be held hostage when a big provider of private money gets into trouble, so the taxpayer doesn't have to bail them out. But if we can ensure the safety, the confidence in money and its value, then our view is we stop there. Now there is a big question about whether citizens have the right to anonymous transactions, cash, or all transactions are ledger-based safer because the state can tax. Should individuals have the right to convert from private money into publicly backed money? For us, the conclusion we've come to is those are societal questions, but they're not for central banks to answer. They're for parliaments, governments to answer about what's the social preference. Big argument on anonymity, and do we gain more as a society from being able to deal with black market illicit transactions than we lose in terms of our liberty with the state knowing exactly who's made every transaction. But they're not for us. They're for politicians. What we need to do is to provide safe, stable money in whatever form society demands it of us. The only problem is the politicians don't seem to be very good at the moment at getting their heads around this issue. But I think it will come.
Yes, there's going to think about there. I'd like to open the floor for further questions. One in the third row back on the right there, and then we'll take 2 or 3 questions together. There's another gentleman on the left here. There's a microphone behind you. Yeah, but first on the right. My right, that is.
Thank you very much. I am Zahid from Turkish Central Bank. I would like to address my question to Mr. Conliffe, but I will be very happy to hear from other speakers. So there is a narrative finding the roots of the global Great Recession on the abolishment of commercial banks and investment banks, the boundaries between them. Looking at the global big data companies, telecommunication or internet service providers, do you believe, are there any activities should be separated? So, for instance, imagine Google providing a currency, digital currency globally. So, and with all the amount of data Google has, should be concerned about these issues, or do you believe in different types of activities should be provided with, by separate entities or not? Thank you.
Okay, and then I take the question. Yes, you, sir. There we go.
Thank you very much for this impressive event. Murat Aydemir from Turkish Central Bank. My question is for Sir John. I wonder that, in his speech, he mentioned that most of the fintech companies in United Kingdom is somehow a little bit small. And also I spent 1 year in United Kingdom inside the ecosystem, fintech ecosystem, so I have some experiences about that, and I have lots of friends who are, fintech entrepreneurs. You are saying most of the fintech companies are small. This is my point of view. One of the reasons is that the size of market, and now it's time to Brexit for United Kingdom. So some of my friends, they are fintech entrepreneurs now. They are moving to Berlin or Frankfurt instead of London. I know that you have a fintech strategy as Bank of England. So do you have any plan to make some modification on your strategic plan to take some step for this Brexit? Thank you very much.
Okay, is there a third question before one at the front here? Can the microphone be brought front row?
Thank you very much. My name is Giuseppe Bruno. I'm from the Bank of Italy. I listened with great attention this talk about crypto assets and cryptocurrency networks. And I had the perception that from the speakers, there is an idea that this kind of payments could be more useful for criminals and for money laundering, these activities. But my question is, do we have a seamless connection between these cryptocurrency, crypto asset networks and the standard payment system? Because if we do, I wonder how can we prevent, say, this activity and then going through this the clean payment system. I mean, that's my sort of doubt. Thank you very much.
Okay, there's three quite provocative questions. We've only got about 5 minutes or so, so if I could ask for some brief responses. John, you had two of the questions there.
Yeah, somebody else can answer on Brexit. I'm very happy for somebody else to answer on Brexit. Maybe Tim would like to do that. Just to say, don't at the moment see that there are some activities that would need to be kept separate. But that doesn't mean there aren't some activities that would need to be kept separate. So if for example, the big tech platforms became banks and have banking licenses, banks are run in a certain way, they have certain types of management and the like, which is a very different way to the way the big techs are organised. We allow supermarkets in the UK to have banks. They're very small, but you can be a supermarket and own a bank, but it has to function as a bank. So I would, if we suddenly discovered Amazon became one of our large banks, we'd want to make sure that there weren't incentives in the other part of the business that could affect the bank companies. I don't know what those might be, but you can see the possibility of that happening. More difficult is if they don't become banks, but they become huge aggregators. So if the customer's relationship with the whole world of financial services is through Facebook, but Facebook takes no risk, it just passes you on to various people. But the whole thing moves very quickly. You wonder about, well, is there some part of the bank operation that is actually with Facebook, even though Facebook has no skin in the game at all? And the second thing you wonder about is what happens in today's world of Twitter and very fast-moving trends when everybody decides that US banks are a bad investment. And suddenly you get a run. And we know that open-ended investment funds can have runs, but if you were to get, let's all get out of emerging market bonds tomorrow, instantly, and we can do it. And then our platforms will automatically switch us out, because as the value goes down, they'll switch us into something else. And those instabilities in market finance could worry me if we were in that world. But I don't know that we're not, I don't see it now, but you think about it for the future. On Brexit, look, I can't tell you what's going to happen, and we'll see. I think the UK is a pretty big marketplace, and it's a marketplace that hasn't gone quite as far as Sweden, but is a marketplace that is very interested in online. We're one of the biggest in online retail, and we're one of the biggest in online financial sector transactions. So there's a question about whether this is a good advanced economy marketplace to be in and develop services, and the regulatory system will try and keep pace in an even-handed way in the way that I set out, not because of Brexit, but because we think that's the right thing to do, and we'll see where people move to and how many people.
Thanks very much. Now, the question on protection of the connections for illicit activity between crypto assets and the traditional system. Who'd like to take that on? Tim?
Yeah, I mean, of course, to the extent that crypto assets just exist in cyberspace and never, then it is both very hard to regulate and also hard to see where the damage is. But I think the point is really that the crypto assets are connected with the conventional financial system and the real economy at various points, including, of course, initial coin offerings where members of the public can exchange money for crypto assets of various, that are being launched. The cryptocurrencies currency exchanges, where again you can either exchange crypto, you can either exchange one crypto asset for another, or you can exchange crypto assets for regular sovereign currencies. And then the third thing is that to the extent you've got crypto assets being used to pay for goods and services and financial assets, then that's another connection between the crypto world and the rest of the financial system. And so generally the regulators have focused on trying to oversee those connections rather than trying to regulate cyberspace with regard to the kinds of crypto transactions that are going on there. But of course that approach is one that still needs to be tested over time, I think. So that's that issue. Wanted to make another observation on the interconnectedness, on the idea of separating activities between different institutions. And I mean, to my mind, one of the lessons we learned 10 years ago was that separating those activities can be somewhat illusory. That in the U.S. in the run-up to the crisis, we heard all sorts of stories about, well, don't worry about the subprime lending because it's all off balance sheet. It's not. It's completely separate from deposit-taking institutions. Deposit-taking institutions are all perfectly safe. And then, of course, what we learned was that despite that appearance of separation, in fact, there were new elements of interconnectedness that nobody had adequately assessed and taken into consideration. And in fact, those other elements of interconnectedness turned out to be huge amplifying forces in the crisis that we went through 10 years ago. So again, even I think we want to look at modes of separation, but I think really more important to try to understand where the interconnections are in the system that exists.
Thanks. I'd just like to add one, coming back to the first question you answered, Tim, I'd just like to add one point there from an international standard setting point of view, which is we've really found in the Financial Stability Board over the last 2 to 3 years that the connections in our work with FATF's work have been growing, and the need for those what seem to be totally separate regulatory types of bodies to speak a similar language, or at least to understand each other's language and understand the way that risks are perceived in those different areas have really grown. So in correspondent banking, in remittances, in crypto assets, the need to bring that legal enforcement side from FATF and the financial risk side together and understand how they interact are very important. So Demet, should I be bringing this to a close now? We're slightly overrunning our time.
Sounds good, thank you.
So I think we've reached the end. The important family photo, I think, is coming up next on the agenda. So thank you very much to the panelists for their insights and for raising a lot of questions that we'll come back to in the course of the day, I'm sure. Thank you.